A person opens their phone and sees someone turn $500 into $10,000. The account balance is right there on the screen. Green numbers, winning trades. Maybe a Lamborghini parked in the background. Maybe a screenshot showing a six-figure withdrawal. The message is simple. You could do this too. And that message has created one of the most profitable industries built around the desire to get rich. But there is a problem. The foreign exchange market is real. Banks trade currencies every day. Governments move billions through it. Multinational companies use it to protect themselves against currency fluctuations. Hedge funds trade it. Central banks intervene in it. So, Forex itself isn't a lie. The lie is what happened when the world's largest financial market was repackaged for ordinary people. Because somewhere along the way, Forex stopped being presented as a complicated market used by institutions to manage enormous amounts of money, and started being sold as a shortcut to financial freedom. And once that happened, a strange business model emerged. You didn't necessarily need to become a great trader to make money from Forex. You could make money selling people the dream of becoming one. And that distinction explains almost everything.
Foreign exchange exists for a simple reason. Money has different currencies. An American company buying equipment from Germany needs euros. A Japanese company selling products in the United States receives dollars. A Nigerian company importing goods may need dollars to pay an American supplier. Every time money crosses a border, currencies have to be exchanged. That creates the foreign exchange market. At the institutional level, this is an enormous machine. Banks trade with other banks. Institutions hedge their exposure. Investment firms speculate on currencies. Central banks manage reserves and intervene when necessary. The market is massive, decentralized, and operating around the clock during the business week. But here's the important part. For most of its history, ordinary people couldn't easily participate in it. You weren't sitting at home with a smartphone placing trades worth tens of thousands of dollars. The infrastructure simply wasn't designed around you. Banks had the relationships. Institutions had the technology. Professional traders had access to information and enormous pools of capital. The average person had none of that. Then technology changed. The internet made financial markets accessible from almost anywhere. Online brokers could aggregate prices, provide trading platforms, and allow individuals to speculate on currency movements without needing to physically exchange large amounts of cash. And that created a new customer, the retail trader. At first, this looked like financial democratization, and in some ways it was. A person sitting in a bedroom could now access a market that had previously been dominated by institutions. But accessibility created another opportunity. If millions of ordinary people wanted to trade, somebody had to provide the infrastructure, and somebody was going to get paid. The first business model was simple. The broker didn't need you to become a billionaire. The broker needed you to trade. That's a crucial difference. Every trade creates economic activity around the transaction. Depending on the broker and account structure, revenue can come from spreads, commissions, financing charges, and other fees. The more frequently customers trade, the more opportunities there are for the broker to earn revenue. That creates an interesting incentive. A long-term investor might buy an asset and hold it for years. A highly active retail Forex trader can open and close positions dozens or even hundreds of times. Each transaction gives the financial intermediary another opportunity to earn. And then leverage entered the picture. This is where the entire industry became much more interesting. Suppose you have $1,000. Without leverage, your potential position is limited by that $1,000. But with leverage, a broker can allow you to control a position many times larger than the amount of money sitting in your account. Suddenly, $1,000 doesn't feel like $1,000 anymore. It feels like much more. And psychologically, that changes everything. A trader who sees a possible $100 profit on a $1,000 account may think that's only 10%. But if leverage allows that same trader to control a much larger position, the potential percentage gains become dramatically larger. The problem is that losses become dramatically larger too. Leverage doesn't make the market more predictable. It simply makes the consequences of being wrong arrive faster. And that distinction is often buried underneath the excitement, because you can lose your money faster isn't particularly good marketing. You can control $100,000 with $1,000 is. The U.S. Commodity Futures Trading Commission has repeatedly warned retail traders about exactly this problem. In an advisory on over-the-counter Forex, the agency explained that a 2% margin requirement could allow someone to control a $100,000 position with just $2,000, while also warning that leverage amplifies losses and can potentially wipe out the trader's margin. And the numbers become even more uncomfortable when you stop looking at individual screenshots and start looking at entire populations. The CFTC says that based on quarterly profitability data from registered U.S. retail foreign exchange dealers, roughly 2 out of every 2 retail Forex traders finish each quarter losing money. In Europe, the picture has historically been even harsher for leveraged CFD products. ESMA found that 74 to 89% of retail CFD accounts typically lost money, with average losses ranging from roughly €2,600 to €29,000 depending on jurisdiction. And in Australia, ASIC reported that during the 2024 financial year, 68% of retail CFD investors lost money, with combined losses exceeding 458 million Australian dollars, including $73 million in fees. Those figures don't mean every Forex trader loses. They mean something more important. The winning screenshot you see online is not representative of the average customer.
There really are people who made fortunes. And this is where the story gets complicated. Because if every Forex success story were fake, the entire industry would be much easier to dismiss. There are people who genuinely became extraordinarily successful trading currencies. One of the most famous examples is George Soros. In 1992, Soros and his quantum fund built a massive short position against the British pound, betting that the United Kingdom would eventually be forced to abandon the pound's position inside the European exchange rate mechanism. On September 16, 1992, Britain was forced to withdraw from the system after failing to keep the pound within its required trading range. The day became known as Black Wednesday. Soros reportedly made around $1 billion from the trade. That is a genuine currency trading fortune. But notice something. Soros wasn't sitting in a bedroom with $500. He wasn't selling a $99 course promising financial freedom. He wasn't posting a screenshot on Instagram telling strangers to copy his entries. He was running an enormous investment operation with access to research, capital, institutional relationships, and sophisticated risk management. Another famous professional currency trader is Bill Lipschutz, who began trading while studying at Cornell. His early story sounds almost identical to the fantasy sold by modern trading influencers. He reportedly turned $12,000 into $250,000 while at university. Then he made a disastrous decision and lost the entire position. Instead of proving that Forex was a guaranteed path to wealth, the experience became one of the lessons that shaped his later approach to risk. Lipschutz eventually joined Solomon Brothers in 1982 and became one of the firm's leading foreign exchange traders. By 1989, he had become managing director and global head of foreign exchange. That's important, because legitimate success exists, but the legitimate version of the story usually looks very different from the Instagram version. It involves years of experience, large amounts of capital, institutional infrastructure, risk management, and sometimes enormous losses along the way. The existence of George Soros and Bill Lipschutz doesn't prove that an ordinary person can turn $500 into $500,000. It proves that Forex trading is a real profession in which some people have achieved extraordinary results. Those are two very different claims. Then Forex discovered something more valuable than trading. It discovered aspiration. The retail Forex industry didn't just have a financial product, it had a story. Work from your laptop, trade from anywhere, wake up whenever you want, leave your 9 to 5, make money while traveling, become financially free. And unlike many traditional investments, Forex could be presented as an activity. You weren't just buying an asset and waiting, you were doing something. Charts, candlesticks, indicators, entries, exits, stop losses, take profits. The screen made the entire process feel controllable. And once something feels controllable, people become willing to believe they can master it. That is where the marketing opportunity became enormous. Because now the product wasn't simply Forex. The product was competence. Someone could tell you, you don't understand the market because nobody taught you the right strategy. And suddenly your losses weren't evidence that the market was difficult. They were evidence that you needed another course, another strategy, another indicator, another mentor, another signal, another trading community, another account. The industry had found a customer who could keep buying the explanation for why they hadn't succeeded yet.
The luxury car changed everything. Then social media arrived, and Forex found the perfect advertising platform. A traditional financial advertisement might show charts, professionals in suits, and complicated terminology. Social media didn't require that. It could show the outcome: a Ferrari, a Rolex, a luxury apartment, a private jet, a screenshot of a trading account, a laptop sitting beside a swimming pool, and underneath it, "I made $37,000 today." The viewer doesn't see the years of experience. They don't see the losing trades. They don't see the leverage. They don't see the risk. They don't see the possibility that the person made more money selling courses than trading. They see the Lamborghini, and the Lamborghini becomes the proof. This is one of the most powerful forms of marketing because the product doesn't have to be explained. The lifestyle explains it for you. You don't need to understand a trading strategy. You just need to understand what $50,000 a month looks like. And that's when Forex stopped competing only with other financial products. It started competing with the human desire for freedom. The influencer doesn't need to win. This is where the business model becomes particularly interesting. Imagine two people. Trader A makes money consistently from trading. Trader B struggles to make money trading, but discovers that thousands of people are willing to pay to learn how he supposedly does it. Trader A has a difficult business. Trader B may have a scalable one. Because trading has a fundamental limitation. Your capital limits the amount of money you can make. If you have $1,000, even an extraordinary return doesn't automatically turn you into a millionaire. But education doesn't have the same limitation. A trading course can be created once and sold thousands of times. A signal service can have hundreds or thousands of subscribers. A private community can charge monthly fees. An affiliate can receive commissions for referring customers to brokers or other financial services where permitted.
A social media account can generate advertising revenue. A personal brand can sell mentorship. The audience becomes the asset, and suddenly the person teaching Forex doesn't necessarily need Forex to be the main source of income. Forex becomes the content, the lifestyle becomes the advertisement, and the audience becomes the business. That doesn't mean every Forex educator is a scammer. There are legitimate traders who teach. There are legitimate educational businesses. There are people who genuinely know what they are doing. The problem is that social media doesn't make it easy to distinguish them from people whose strongest skill is marketing. And that distinction matters, because being good at convincing people that you're good at trading is not the same skill as being good at trading. The affiliate who never places a trade. And this is where another layer of the business appears. You can participate in the Forex economy without ever becoming a trader. You can become the person who brings traders into the system. That's affiliate marketing. A creator publishes a video. A viewer clicks a referral link. The viewer opens an account. They deposit money. They begin trading. Depending on the arrangement and jurisdiction, the affiliate can receive compensation connected to the customer they referred or the trading activity that follows. The important part is that the affiliate's financial outcome may be completely different from the trader's. The trader is trying to predict Euro USD. The affiliate is trying to predict something much easier: how many people will click the link. The CFTC has explicitly warned that retail Forex dealers may use social media influencers and affiliate marketers to bring customers onto their platforms, and that some arrangements compensate promoters according to the number of customers they deliver. There are even documented cases showing just how sophisticated referral structures can become. In the CFTC's case against Mirror Trading International, investigators described a multi-level affiliate system involving direct referral bonuses and multiple levels of additional rewards. The scheme allegedly used a multi-level structure where participants could earn compensation for bringing in new members and building networks beneath them. And this is where the economics become fascinating. The person promoting the opportunity doesn't necessarily need to prove that every follower becomes wealthy. They need people to sign up. The business model can monetize the acquisition of the customer before the customer ever becomes successful. That changes the entire incentive structure, because now there are two separate questions. Can the customer make money? And can the person who recruited the customer make money? Those answers don't have to be the same. Then came the signal business. The next step was even easier. You didn't have to learn to trade. Someone else could trade for you, or at least tell you when to enter. A signal provider sends buy Euro USD, entry price, stop loss, take profit. The customer follows. The appeal is obvious. You don't need years of chart analysis. You don't need to understand macroeconomics. You don't need to spend hours studying. You just copy the person who supposedly knows what they are doing. And once again, the business model benefits from activity. A successful signal provider can sell access to hundreds or thousands of people simultaneously. The marginal cost of sending another signal is almost zero. That is a beautiful business model. One person takes an action, an entire audience pays for access to that decision, and the provider can potentially make money regardless of whether every customer becomes a successful trader. But there's even a deeper psychological trick. When someone loses money following a signal, they don't necessarily conclude Forex is impossible. They might conclude that signal was bad, so they search for another provider, and the cycle continues.
Now the signal doesn't even need a human. And this is where the newest version of the business enters: AI. Open social media today and you will find people selling automated trading systems with names designed to sound almost futuristic. AI Forex bot, smart trading robot, algorithmic trader, automated profit system, machine learning signals. The pitch is usually simple. Connect the software to your broker, deposit your money, turn the system on, let the algorithm trade. You sleep, the robot works, you wake up richer. It sounds like the perfect evolution of the Forex dream. You don't even need to become the trader anymore. You just need to own the machine. But there is an important distinction. Automated trading is real. Artificial intelligence is real. Algorithmic trading is real. What doesn't automatically follow is that a piece of software can reliably predict future currency prices. An automated trading system is fundamentally a set of rules. The software can monitor prices, it can calculate indicators, it can identify conditions, it can send orders, it can close positions, it can enforce stop-loss rules. It can do all of this much faster and more consistently than a human. But speed isn't prediction. Automation isn't intelligence. And artificial intelligence doesn't eliminate uncertainty. A robot can follow a strategy perfectly and still lose money. Imagine a system programmed to buy whenever a particular combination of indicators appears. The market changes. The relationship that worked during the previous 5 years disappears. The robot doesn't know that. It simply follows the rules. That's one reason regulators have become increasingly concerned about the way AI is being marketed to inexperienced investors. In January 2024, the CFTC published a specific warning titled "AI won't turn trading bots into money machines." The agency said fraudsters were exploiting excitement around AI to promote automated trading algorithms and signal systems promising unreasonably high or guaranteed returns. The CFTC made the point very clearly. AI cannot predict the future or sudden market changes, and that is the part the marketing conveniently leaves out. The $5 million AI bot case. There is an even more disturbing example. In October 2023, the CFTC announced a case against a company called Technical Trading Team, along with its CEO, Edwin Carrion, and COO, Jason Rodriguez. According to the CFTC's complaint, the company solicited approximately $5 million from 27 participants for a Forex commodity pool. The alleged trading lost more than $3.13 million. And then came the interesting part. According to the complaint, after the losses occurred, the defendants allegedly told investors that they would recover the money using a new AI-powered trading bot. The bot was presented as a solution to the problem, but according to the CFTC, the representations about the AI system were false or misleading. Think about the psychology of that situation. The investors already had money at risk. They had already been told there was a problem. Then a new technology appeared that supposedly solved it. AI became the next chapter of the story. Not because the technology had necessarily solved the underlying trading problem, but because the word AI made the promise sound more sophisticated. That's an important lesson. Technology can change. The business model doesn't have to. The $58 million robot. And this wasn't the only case. In 2022, the CFTC charged 5 entities and 5 individuals connected to a scheme known as ROFX. According to the complaint, the operation allegedly solicited at least $58 million from more than 1,100 customers. The marketing claimed that the system used a highly successful automated trading robot and even guaranteed coverage of losses. The alleged result was very different from the promise. The CFTC accused the defendants of fraud and misappropriation. This is where the word robot becomes important. Because a robot sounds objective, it sounds mathematical, it sounds emotionless, it sounds like something that doesn't make mistakes. And that's exactly why the concept sells so well. A human trader can panic, a robot can't panic. A human trader can become greedy. A robot follows its code. A human can revenge trade after a loss. Software doesn't have emotions. All of that can be true, and the system can still lose money. Because the problem isn't always human emotion. Sometimes the strategy itself is wrong. Let's strip away the marketing. An automated Forex system generally sits between market data and a trading account. The software receives price information. It processes that information according to predefined rules. Then, when certain conditions are met, it can send an order through the trading platform or broker. For example, the system might be programmed to buy Euro USD when a short-term moving average crosses above a longer-term moving average. It might place a stop loss below a certain level. It might take profit after a predefined percentage gain. It can repeat that process thousands of times without getting tired. That's automation. More advanced systems can incorporate statistical models, machine learning techniques, or multiple data sources. But even then, the machine is learning patterns from historical information. The future doesn't have to behave like the past. And that's the fundamental weakness. A backtest can look incredible. A chart can show years of profitable trades. The software can display a beautiful equity curve. But the future hasn't agreed to follow the historical pattern. This is why sophisticated investment firms spend enormous resources testing models under different market conditions. They don't assume that a profitable backtest equals a guaranteed future. Yet the retail marketing version can compress all of that complexity into "our AI has a 95% win rate." That's a very different proposition, and a much more dangerous one.
The most dangerous number is the win rate. Imagine someone tells you, this robot wins 90% of its trades. It sounds incredible. But win rate alone tells you almost nothing. Suppose the system wins 9 trades at $10 each. That's $90. Then it loses 1 trade at $150. The account is down $60. The system won 90% of its trades and still lost money. This is why professional traders care about much more than winning percentages. They look at position sizing, average win, average loss, maximum drawdown, risk-adjusted returns, correlation, liquidity, slippage, transaction costs, and how the strategy behaves when market conditions change. The retail customer usually sees none of that. They see 90% win rate, and that's enough to sell the dream. Then, Forex became a course. This might be the most important transformation of all, because education is one of the easiest products to sell around a difficult activity. Suppose somebody discovers a genuine trading strategy. They can trade it, or they can teach it. If they trade it, their income depends on capital and performance. If they teach it, their income can depend on the number of students. That creates a completely different economic incentive. Imagine selling a $500 course. You don't need 1 million customers, you need 2,000. That's $1 million in gross sales, and the course doesn't have to physically manufacture anything. No warehouse, no shipping, no raw materials, no inventory, just videos, PDFs, a community, and marketing. The economics are extraordinary, and the best marketing asset is often the teacher's own apparent success, which brings us back to the cars. The car isn't always the product. Sometimes the car is the billboard. But there's a problem with the dream. Trading is not an ordinary skill. You aren't simply competing against someone who hasn't studied as much as you have. Depending on the market and instrument, you're interacting with professional institutions, sophisticated algorithms, banks, hedge funds, and other traders who have vastly more resources. And even professionals don't have a magical ability to predict markets. Currency prices are affected by interest rates, inflation, economic data, central bank policy, geopolitical events, capital flows, expectations,
expectations, and countless other variables. A trader can be intelligent and disciplined and still lose money. That's what makes the marketing so dangerous. It can make uncertainty look like incompetence. If someone tells you, "You lost because you didn't follow my strategy correctly," you may buy the next strategy. But sometimes the uncomfortable answer is simply, "You took a risky position in an uncertain market and it went against you." There isn't always a secret missing indicator. The account size illusion. There's another trick that makes Forex screenshots incredibly powerful. Percentages. Someone shows you $2,000 profit today. That sounds enormous, but you don't know the account size. Maybe the trader has $500,000. A $2,000 gain is less than 0.5%. Maybe they risked $20,000 to make it. Maybe it was a lucky trade. Maybe the screenshot shows one winning account while several losing accounts aren't shown. The screenshot gives you the result, it doesn't give you the distribution, and that is an enormous difference. A casino can show somebody winning $50,000. That doesn't tell you how much everyone else lost. One winning trade doesn't establish a trading system. One winning month doesn't establish a business, and one screenshot certainly doesn't establish financial freedom. Then the industry found another customer, people who wanted to trade but didn't have enough money. Enter the funded account model. The basic concept is attractive. A trader pays a fee to take an evaluation or challenge. If they meet certain performance requirements while respecting risk rules, they may receive access to a larger account or profit-sharing arrangement, depending on the firm's model. For the aspiring trader, it sounds perfect. You don't need $100,000 of your own money. You just need enough to pass the challenge. But once again, there's a business on the other side. Thousands of people are willing to pay evaluation fees because they dream of controlling a much larger account. The company has created a product around that ambition, and the economics can become fascinating. A trader fails, they pay for another attempt. They fail again, another attempt. The cycle can repeat. Again, this doesn't automatically mean that every funded trading company is fraudulent. Some operate legitimate businesses. Some traders genuinely succeed. But the business model demonstrates something important. The desire to become a trader itself can be monetized, and that is the central theme running through the entire industry. The real product may be hope. Think about the customer journey. Someone sees a Forex video, they become curious, they watch another, then another. The algorithm recognizes their interest. Suddenly their feed is full of trading content, profitable trades, luxury lifestyles, trading psychology, signals, courses, mentors, funded accounts, broker advertisements. The persons start believing everyone around them is making money. They're not seeing the thousands of people who tried and quietly stopped. They're not seeing the accounts that disappeared. They're not seeing the people who lost money and never posted about it. They're seeing survivors. This is survivorship bias turned into an advertisement machine. The winners become visible, the losers become invisible, and the invisible majority can make the visible minority look normal. That's powerful, because if you see 10 people driving expensive cars and all 10 claim Forex paid for them, you don't naturally think about the thousands of people you never saw. You think, maybe I'm the only one who hasn't figured it out yet, and that's exactly the mindset that keeps the funnel alive. Real people really did lose millions, and sometimes the losses weren't hidden behind anonymous usernames. Regulators have documented individual cases involving millions of dollars. In December 2023, a U.S. federal court ordered Florida resident Avinash Singh and his company High Rise Advantage to pay more than $102 million in restitution and civil penalties over a Forex fraud case. According to the CFTC, High Rise collected almost $58 million from investors and feeder funds, but used less than $2.5 million for actual Forex trading. More than $25 million was allegedly misappropriated, with investor money also used for Ponzi-type payments and personal expenses. Another case involved Kay Yang and her companies AK Equity Group and X Sapphire. In June 2023, a federal court entered a judgment requiring Yang and her companies to pay more than $24
$24 million in restitution and penalties. The court found that Yang had solicited at least $15.7 million from approximately 67 people or entities for participation in a commodity pool that supposedly traded Forex. The case reportedly targeted members of the Hmong community in Wisconsin. Then there was Darren Robinson. According to a September 2023 CFTC statement, Robinson and his company allegedly received around $7 million from 30 victims for a Forex investment pool. But instead of using the money as promised, the CFTC said Robinson spent funds on luxury cruises, vehicles, real estate, airfare, and other expenses. Around $1.2 million was allegedly used to make payments to earlier investors, creating the appearance of trading profits. These aren't stories about somebody losing a bad trade. These are examples of something much darker. People believing they were investing in trading when their money was being used somewhere else. And that's why understanding the business behind the promise matters. The $1.7 billion case. Then there is perhaps the most dramatic of all, Cornelius Johannes Steinberg. Steinberg founded Mirror Trading International, commonly known as MTI. The company presented itself as a Forex trading operation using proprietary software. Customers could put money into the system without traditional trading experience. The pitch was built around automated trading, and there was another layer, an affiliate program. Members could refer other people and receive bonuses. That meant the business wasn't relying on traditional advertising. Its own customers could become its sales force. According to the CFTC, MTI accepted at least 29,421 Bitcoin, valued at more than $1.7 billion at the end of the relevant period, with additional victims around the world. In September 2023, a U.S. federal court entered an order requiring MTI to pay more than $1.7 billion in restitution. The CFTC said virtually all of the money had been misappropriated. The case is important for another reason. The marketing wasn't simply "give us your money," it was "bring other people." The CFTC's complaint described a multi-level affiliate structure involving direct referral bonuses, binary bonuses, and leadership pools. So the customer could become the marketer could recruit another customer, the new customer could recruit someone else, and the entire structure could expand through personal networks. This is where a financial product becomes something much larger. It becomes a distribution machine.
The industry doesn't need everyone to win. This is where the economics become uncomfortable. Imagine an industry with 1 million aspiring traders. If every single person became consistently profitable, the industry wouldn't necessarily collapse, but the marketing would lose some of its urgency. The dream works because becoming financially independent through trading feels difficult but possible. If it were impossible, nobody would buy. If it were easy, nobody would need to keep buying education. The sweet spot for the marketing is hard enough to need help, possible enough to keep trying. That is a powerful commercial position, and it exists far beyond Forex. Weight loss programs use it. Online business courses use it. Sports betting systems use it. Cryptocurrency influencers use it. The customer isn't only buying information, they're buying another chance. But this is where the story needs an important distinction. Forex is not fake. Currencies genuinely move. Businesses genuinely hedge currencies. Institutions genuinely trade them. Professional traders genuinely make money from them. There are retail traders who make money too. The problem is the leap from "some people can make money trading currencies" to "you can easily learn to make huge amounts of money trading currencies from your phone." Those are completely different claims, and social media often compresses them into the same message. A legitimate market can support an illegitimate marketing narrative. That's the real story. Why the dream is so hard to kill. The Forex dream survives because it satisfies several desires at once: money, freedom, status, control, escape from employment, and most importantly, speed. People don't just want to become wealthy, they want to become wealthy quickly. Because if someone tells you, invest consistently for 30 years, that's financially boring. But if someone tells you, turn $500 into $50,000, now you've got a story. The probability may be radically different, but emotionally the second story is much more powerful. And businesses understand emotion better than most customers understand probability. The most profitable trade. There's an irony at the center of the entire industry. The person who wants to make money from Forex often believes the money is in predicting currencies. But some of the businesses surrounding Forex make money from something much easier to predict: people's desire to become rich. That's a more stable market. Currencies can move unpredictably. Human aspiration is remarkably consistent. People want more money. They want more freedom. They want to stop worrying about bills. They want to impress people. They want to escape jobs they hate. They want to believe they're one strategy away from changing their lives. And as long as those desires exist, there will be a market for someone selling the solution. The Lamborghini was never the point. This is why the Lamborghini matters. Not because every Forex influencer with a Lamborghini is fake, not because every successful trader is lying, but because luxury is an incredibly efficient advertising language. You don't need to explain compound returns. You don't need to explain currency correlations. You don't need to explain monetary policy. You just show the outcome. The viewer fills in the rest. He has the life I want. He says Forex paid for it. Therefore, Forex might be my way out. That's the psychological transaction. And once the viewer believes that, the next step becomes easy. Click the link, join the group, buy the course, open the account, take the challenge, subscribe to the signals, start trading. The funnel is complete. So, is Forex a lie? Not exactly, and that's what makes the story more interesting. The market is real, the opportunity is real, the risks are real, the businesses are real. The problem is the story wrapped around them. Forex was transformed from a complex financial market into a lifestyle product. The industry discovered that selling access wasn't enough, so it sold education. Education wasn't enough, so it sold mentorship. Mentorship wasn't enough, so it sold signals. Signals weren't enough, so it sold funded accounts. And underneath all of it was the same promise: you can become one of the people who made it. That's the product, not the currency pair, not the chart, not the indicator, the possibility. And that's why the best question isn't, can Forex make you rich? Of course it can. Some people have made enormous amounts of money trading currencies. The more useful question is, who is making money from your decision to try? Because there is an entire ecosystem waiting for you before you even place your first trade. Opening an account can generate revenue somewhere in the chain. Trading frequently can create another source of income for the intermediary. Educational platforms monetize your desire to improve. Signal services charge for access to trade ideas. Communities turn participation into recurring subscriptions. Funded accounts companies charge for evaluations and repeat attempts. And then there's you, the person actually risking the money. That doesn't prove the entire industry is a scam. It proves something more important. You need to understand the business model before you become the customer. Once you understand where the money flows, the marketing starts looking very different. The Lamborghini becomes an advertisement. The screenshot becomes a sales asset. The free webinar becomes a funnel. The Discord community becomes a subscription product. The trading course becomes digital inventory, and the dream of financial freedom becomes the commodity being sold. The final trade. There's nothing inherently wrong with wanting to trade.
There's nothing inherently wrong with learning about markets. There's nothing inherently wrong with trying to build wealth. But there is a massive difference between taking a calculated financial risk and buying someone else's certainty. The market doesn't owe you a profit because you watched 20 hours of tutorials. It doesn't care how badly you need the money. It doesn't care about the Lamborghini on your Instagram feed. It doesn't care about your mentor, and it doesn't care how many indicators you have on your screen. Markets can humble people with decades of experience. That's why the most dangerous part of Forex isn't necessarily the currency market itself. It's the belief that someone has discovered a simple formula that the rest of the financial world somehow missed. Because if the formula really worked exactly the way it was advertised, the most profitable thing to do would probably not be selling it for $99. You'd use it yourself. And that is the uncomfortable question sitting underneath the entire industry. If someone has genuinely discovered a reliable way to turn tiny amounts of money into enormous fortunes, why is their primary business teaching strangers how to do it? Sometimes there is a perfectly legitimate answer, and sometimes the answer is the business itself. That's why Forex isn't really the lie. The lie is the idea that the fastest way to make money from Forex is necessarily to trade Forex. Because sometimes the biggest opportunity isn't inside the market, it's standing outside the market, watching millions of people arrive with the same dream and building a business around that dream. And once you see that, the entire industry looks different. The charts are still moving, the currencies are still being traded, the brokers are still operating, the traders are still taking positions. But now there's another market you can see, a market built around something even more predictable than currency prices, the human desire to get rich.